I'm not an expert in technology, and I'm an economist, so I can only hope to add value to this event through contextualizing what's going on in technology in the context of market events, in the context of macroeconomic themes, and also in the context of evolving relationship and trade tension between US and China. So to start, I want to actually take a higher level approach to what's going on in the world by outlining our three investment themes that we have evolved throughout the course of this year and into the remaining part of this year as well. The first key investment theme that we think matters a lot and very much behind market performance so far this year is really this shift towards protectionist push. And also, as a result of that, more proactive policymakers. So what do I mean by that? If you think about some of the trade tension, escalation that at various points so far this year led to market volatility driven by US, driven by China, that has very much characterized the sort of market volatility environment that we're in right now. And it does mean that there will be other factors that are expected to come to the rescue if trade tension ramps up, if that dampens investment sentiment, and also if that dampens growth outlook as well. And some of the examples of this kind of factors coming to the rescue has been central banks, has been greater fiscal stimulus, fiscal spending expectations. So if you think about this remarkable move that markets have witnessed so far this year, expecting US central bank movement. At the beginning of the year, we're all wondering how many rate hikes that the biggest central bank in the world, the Fed, is going to deliver for the year. But throughout the course of this year, we gradually accepted that, you know what, the central bank is going to start cutting to support growth, to support sentiment in response to rising trade tension. And now we're after the first rate cut in over a long time, we're still looking at two more further rate cuts by the central bank in the US by the remaining part of this year, which is extremely dovish pivot by the Fed. And it is not just the Fed that is coming to the rescue in response to greater trade tension. It is also the ECB, the European Central Bank. It is also the PBOC, the Chinese Central Bank. There's a greater recognition that because globalization is taking a little bit of a pause because of the protectionist push, that other forces need to come to the rescue. And we're seeing, for example, later today, we will see what ECB managed to deliver in terms of rate cut, in terms of further easing package. And we have also seen rate cuts by the People's Central Bank in China. So that's the first investment thing, which has very much driven risk on market performance, which I will talk to in the second slide. The second investment theme is, as a result of this protectionist push and central bank coming to the rescue, where are we in the economic cycle? So currently we're in the longest economic cycle in the US, the 10th year, which is remarkable given how long it has been. And our view is, because the central bank has come to the rescue, and because we think that there is further room to go, we're not looking at the end of the cycle just yet. Even though when investors look at how the US government bond and the shape of the curve is indicating maybe recession is not far, we actually think that we are in this cycle for a bit longer. And another point I want to make is that whenever we talk about kind of the length of the cycle, automatically focus goes to the US economy, which is fair because it's the biggest economy in the world. But China is actually still mid-cycle. We're talking about growth at 6.2%, which is low, the lowest in a very long time. But given that it is the second biggest economy, growing at a high single digit, it is remarkable in terms of its contribution to global incremental GDP growth. And as a result of the fact that we see further room to go in the economic cycle in the US, and also the fact that China is very much mid-cycle, We think that investors, as a result of that, need to stay invested in market. I know it feels a bit scary because we have been in this bull market for a long time. It feels a bit scary because of trade tension, oftentimes manifesting itself in technology confrontation. We feel investors need to stay invested because markets are still going very, very strong. We're seeing the performance on the second slide. And the third investment theme that we have evolved throughout the course of this year is really very much combining the first two themes, recognizing that central banks are becoming more dovish, recognizing that the cycle is getting longer. However, protectionist push raises causes for concern. We think that investors, when it comes to asset allocation, really need to think about combining both high conviction ideas that you want to invest in with diversification on the other side. Where do you want to invest in if things go wrong? It could be gold, it could be government bond, it could be cash even, but you need to think about balancing both sides of the coin because it is a more volatile environment that we are in now in comparison with 2 years ago, for example. I'm just going to quickly put things into context in terms of what I just talked about in terms of asset performance, which is what is really incredible is that so far this year it has been a very good year. If you look at kind of the green bar, that is the year-to-date performance for most of the asset exposures showing positive. But what is very, very remarkable is that the top two exposures, one is technology, Nasdaq Composite, and the second is actually gold. So it's very unusual that the highest performing exposures on the year, one is risk-on, distinctively risk-on, distinctively cyclical, and the other one is distinctively defensive and distinctively risk-off. And this really goes to show that this barbelling approach that I talked about in terms of combining your high conviction idea with your diversification, such as gold, is really paying off. So one thing to just put things into perspective as well is that we looked at kind of the monthly return during the course of August market volatility as represented by the pink dots here. And it really goes to show that even though on a year-to-date basis, performance has been quite good, it's vulnerable to potential market correction. And if you specifically think about kind of the price of oil, Brent crude here, year-to-date performance could be wiped out quite quickly. And that is something to bear in mind to recognize that this increasingly volatile environment that we are in, very much driven at many points so far this year by confrontation, trade tension between the US and China. Now, just to put things into perspective and also showcasing a little bit in terms of the technology that BlackRock incorporates in our investment process, this is what we call BlackRock Geopolitical Risk Indicator, which very much incorporates the latest technology in terms of using text analysis to calculate the frequency of certain words appearing in broker reports, in newswire databases, and try to understand to what extent markets are paying attention to key geopolitical developments. Specifically, in this case, we're talking about kind of the trade, focus on trade tension. And we see that year to date, very much so, it has ramped up. And if you think about some of the tariffs imposing from China to US and from US to China, this is not surprising that we see a bit of a spike up, but putting things into perspective, last year we have seen even higher elevated levels of this focus on trade tension. And I'm going to actually spend quite a little bit of time talking to this particular slide. And this very much kind of contextualizes the relationship between US, China, the superpower and the emerging superpower in the world. And if you think about more recent years' development in terms of seemingly trade tension coming to the fore, coming to the front, it's very much important. It's very, very important to contextualize that and take note that this is not just the last few years, this is not just the last few quarters, things getting a bit more confrontational. It is actually many years and decades in the making. Ultimately, what we're witnessing right now is really the emergence of the next superpower, kind of getting closer and over time overtaking the current superpower. If you look at the incremental GDP growth of the two economies, and as a result of that, inevitably, there will be a confrontation, and currently it is manifesting in technology, spending, intellectual property. We don't see that going away anytime soon because it is many years and decades in the making. Now, having said that, it is also important to kind of think of it as almost a curve going higher with ebbs and flows, where even though we don't see the chances of a comprehensive trade deal between China and US being high in the medium term, just because of this confrontation, strategic confrontation that I am talking about, we do see chances of headline relief reasonably high. If you think about overnight, the good gesture from the U.S. to postpone the imposition of some of the tariffs by 2 additional weeks. And if you think about the upcoming trade talk that is happening in late October, it definitely signals that after summer tension escalating, we're now entering a little bit of a phase of an incremental headline relief. And that is actually catalyzing very strong performance by both the US market as well as China market. Currently, Chinese equities is actually up more than 20% on the year, which is incredible given the fact that if you look at flows by investors across the board, we actually haven't seen a lot of participation into this particular market, even though it has done very well. And the dislocation between the good performance and the lack of appetite, the lack of allocation, the lack of flows going into these exposures is very much around kind of the concern about trade tension flare up. I would also just putting things into perspective here. When we talk about US economy, China economy, we see them converging, and at some point with China kind of overtaking given the size of the base and the size of the nominal growth. Just to throw a few statistics out there, which is mind-boggling, which is really, really remarkable. Over the last 5 years or so, China's incremental contribution to global GDP growth is a third of the overall incremental growth globally. The equivalent number for the US over the last 5 years is a tenth. So China's incremental driver is already surpassing that of the US. And going forward, given the growth rate that is expected from the Chinese economy, the incremental driver of China to global GDP growth is going to stay at around a third, whereas the equivalent number for the US is actually going to go from currently over the last 5 years a tenth to a 20th. So the relative positioning is really, really shifting, which is why when we speak to clients, we oftentimes get asked, well, how do I manage my China allocation? I don't really hold a lot. I am worried about technology confrontation. I'm worried about trade war. When do I get in? It's hard to be tactical about it, to time the precise moment to allocate to China for the very first time. But if you take a step back and look at it from a strategic perspective, the direction of travel for international investors should almost always be more China rather than less China. If you think about the relative contribution that the economy is adding to global GDP growth and the relative weight that China is currently being represented in international investors' portfolios as well as in international benchmarks. So we're starting to see that trend changing, shifting, as recently demonstrated in MSCI, including China in their emerging market indices, demonstrated by JP Morgan and Bloomberg Barclay indices, including China bond in their emerging market indices. Just off the back of this inclusion events by index providers alone, we're talking about this year potentially looking at $200 billion worth of money in motion in response to the rebalancing to the inclusion events alone. We're currently seeing far less flows across the board into China assets because of trade tension. And we think that when things become a bit better on the headline basis, investors could be chasing that performance. So just to wrap everything up and coming up to my time here as well, is that there is actually a very exciting prospect of the cycle getting longer. And we encourage investors to continue to stay invested because at this point in the cycle, risk assets tend to do well. But definitely barbell your conviction ideas with diversification drivers in your portfolio because frequency of volatility events are likely going to be quite high, driven especially because of this protectionist push, because of this confrontation between US and China, the two superpowers in the world. Technology is very much in the center of that, and over time we could see a bit of a divergence in terms of the path between China technology and US technology because of shift in trade, supply chain. But we think that it presents two distinct opportunities that investors should take advantage of. And I love the band to signal the end of the presentation. Thank you so much for listening to me.